mostly mega caps, right? Large caps are over 10 billion. Mega caps, I believe, are over 100 billion. That's what fits that definition. So if you ever hear them talking to CNBC, that's what they're talking about. But the reason I feel like some of the Russell is going up a little bit on that day, the day that this was filmed, is because people are starting to look more towards evaluation and not just hype and growth. They're actually starting to take a look at the fundamentals of some of these companies and cherry pick them out, because that's what you have to do right now. You have to look for value because everything is priced so high. It's hard to pick something. It's hard to find a good deal.
Look at small and mid-cap participation, so I like that. And again, let's just think about this. This is one of the most seasonally bullish periods of the year. We came into it extremely oversold. Number of stocks over the 200-day moving average, number of stocks over the 10-day moving average, very, very oversold. Where I'd be worried is if we actually sold off, right? When do market crashes happen? When you're oversold, not overbought. We're not doing that. I'll be very clear. We're not doing that flat on the day for the S&P. I get it. But I guess put a bow on this. We're encouraged by the action so far. And if you have a bounce during this seasonally bullish time period, it's really, not a big signal either way. It's when Santa doesn't come to town, and we're not seeing that so far.
All right, Ray, I'm going to have to push back on that small cap theory in just a second. But before we get to that,
Sure.
Vicki, I want to come over to you. Happy holidays to you as well. We've been looking at the action on the 10-year. It's pulled back a bit from the highs that we saw earlier today, but concerned all about this higher yield situation despite the Fed cutting. I mean, if you just go back to
10-year refers to the 10-year Treasury bond. It's tied into housing, directly tied into housing and mortgage rates.
that hawkish cut, we're up just about 20 basis points. Does that concern you about the equity market going into the new year?
Not yet. I mean, it's been an ugly December. I think it's 40 basis points basically moved up here in December on the 10-year. Until it hits 5, I'm not too concerned. I think we're going to top out around where we did in April, around that 4.7, 4.75 area. But there's some good resistance here. So again, I'm not too worried yet. Been an ugly move.
And a lot of analysts are saying it's going to hit 5, especially there's going to be a lot of cutting of programs, which is good because our debt is going through the roof and we're seeing more geopolitical risks when it comes to other competing countries. But I feel like there's going to be some spending first year, definitely. And in order to get that money, they're going to have some treasury auctions. And that should increase the price of the 10-year. Even though that the discount rate, which is set by the Fed, is going down.
Move up, horrible on duration, biting a lot of people's bond portfolios that moved out into that intermediate space and dragging a lot of those negative on the year. But for us, it's not a problem for the equity market yet. Obviously, if we breach 5 and continue to march higher, then I do get a little bit more concerned. But right now, we're still within our inter-year trading range. And so for me, it's a little bit of an eye raiser, but not an actual problem yet.
Ryan, what do you make of what's going on with the 10-year relative to expectations for the Fed? You say that you believe there will still be 2 cuts next year. You don't think it's going to be a no cut or even hike scenario. But does it even matter if market rates are, in such a disconnect territory from what's going on with the Fed?
That's a good question because, listen, why are rates higher?
And that's crazy because, and I'll be honest, like I can calculate bonds, I can do a lot of things with bonds, but I don't understand the disconnect either. And it sounds like my man is if my man has the answer, I'll have to go back to this and kind of see if he has like a Twitter account to kind of see if he has more insight on that. But there's a disconnect between the treasury yields and what the Fed is trying to set.
I mean, is it because inflation's really that much higher? When you look at the CPI and some of the data we saw, we'd say no, it's because the economy is still strong. So, what's really worse? If the Fed cuts 100 basis points next year because the economy is slowing or because the economy is pretty solid? Of course, we would argue we prefer the economy to be solid, but adding to what we just talked about there, yields higher above 10% on the 10-year, yeah, that might be something to upset the apple cart. But the U.S. dollar is that big one, right? If you continue to see strength in the dollar, look what's going on in Germany, look what's going on in France, look what's going on in China. There are some disappointing things happening, right? If the dollar continues to strengthen, that's one of our, I'd say, top 3 worries next year, because when the dollar is really strong, everybody, that's when things don't do that well. Look at the first 10 months.
Yeah, the dollar, yes, but it's things don't do well. Okay, so I want you to think about this, right? Yes, the economy would slow down if the dollar increases because exports would decrease, right? That's just that's the fundamentals of it, right? But the lower end consumer would also be doing better, so these forces kind of counteract each other a little bit to some degree. But obviously a stronger dollar would be worse for the overall economy. It would be good for Americans. We get a little bit more bang for our buck, but it's definitely a headwind for the American economy, especially exporters.
To 22 for a reminder of that. But we're optimistic that the dollar will start to roll over, that yield will start to roll over, as the realization again that if you look at inflation, I know we can talk about it all day, keep it real simple. You look at inflation, why is it higher? It's because of shelter and auto insurance. I mean, those are the 2 main reasons we're having excess inflation on the CPI. So we're optimistic inflation is not a problem, and there will be more cuts coming next year than we think right now.
I would agree with that.
Are you worried at all about a policy error in 2025, just given all these cross currents and kind of unprecedented dynamics that we're seeing on the macro front?
Yes, our 2025 outlook is called bullish with a but, because there's so many things that could go wrong on the policy side, both fiscal and monetary. First off, monetary. Let's make sure the Fed doesn't get it wrong.
Okay, so I was wondering what they meant by the policy side. So she meant both, right? So monetary would be the Fed, right? And the fiscal policy would be the executive branch.
We don't have a transitory situation again here in 2025. We want to make sure they move slow, but they are reactive if they need to be. And it's a hard job. You know, when do you need to be aggressive? When do you need to sit back? You know, and I know inflation has been super sticky. I tend to think inflation is not coming down all that much because housing is super stuck right now. But for us, it's also then what happens on the fiscal side. There are so many expectations baked in,
and the problem with housing right now is that there's a shortage. There's a shortage because the rates have been so high for so long, and housing should continue to increase in price because of that. It's like it's a trifecta worst case scenario for housing, right? So if you're trying to buy a house, that's probably not good news for you, but as soon as housing and the business cycle are closely tied together. So if you were able to get the 10-year down, the 10-year bond down, housing, people would start to re-enter the housing market. Production of housing would increase again, and the business cycle would continue. But I think, and I hate to say this, but if you were to repeal some of the things on the Dodd-Frank Act, you could probably do that and then put it back into place just to get that engine going again. But we'll see. That I don't think anybody's gonna even looking at that. They're more looking at what the Fed can do.
Think they could come true. We're looking at tax cuts, lower regulations, things that are going to stimulate the economy, but you have deficit hawks out there, you have Doge out there, and government expenditures and government employment is a large part of our economy. So you suddenly have these cross currents that make a lot of choppy waters, kind of like Magellan Strait area, that we can navigate it, but it is a lot more dangerous sailing next year. And that's why I say it's bullish with a but, because a policy error is that tried and true way for a bull market to end.